Hello everyone, welcome to the 133rd episode of me learning how to trade in Forex. So in the last episode we went through what is Forex. So basically Forex is how individuals and businesses convert one currency to another. Also known as the FX, foreign exchange, currency market, it's the largest financial market in the world. Who trades Forex? So the Forex market players, basically the big banks, major international banks. Why do people trade Forex? Mainly for speculation, basically are made simply to make money, and a little bit is for purchasing goods or services in another currency. How do you trade Forex? As Forex is over the counter market, this means that currencies are exchanged directly between two parties rather than through an exchange. So, and then we've got the different Forex trading hours for each major market trading center or major Forex trading centers. So you've got the London, New York, Sydney, Tokyo. How does Forex trade work? Whilst trading Forex, you're simultaneously buying one currency while selling another. And then we went through the quiz of select the right country for each of the currency codes. And then we found out the quote. Actually, no. So Forex is made up of two currencies. So we got the one on the left and one on the right. The one on the left is called the base or the primary currency, and the second currency is known as a quote or counter currency. So, and the price that comes out of the Forex pair is how much of the counter currency or the quote currency is needed to buy 1 units of the base or the primary currency. Why does it do that? So in this case, EUR/USD equals 1.20164. That means €1 is worth $1.20164. And then, yeah, we learnt about buying the pair or selling the pair, going long or short. If you think one currency is going to strengthen against another. And then we did a little quiz at the end to calculate how much profit would make if the price went up. And we read through this lesson summary as well. So, now we're on to trading Forex. Trading Forex. Date is a 12. So, what is a pip? Unlike share price movements, which are measured in recognizable units of currency such as percent, pence, or cents, Forex changes are measured in very small units called pips. For example, if the Euro/USD price moves from 1.20160 to 1.20170, that 0.0001 USD rise in value represents 1 pip. Do that. For most major currency pairs, a pip represents a 1-digit move in the 4th decimal place. Yep. So for most major currency pairs, a pip represents a 1-digit move in the 4th decimal place. So like that. So 1, 1, 2, 3, 4, 4th decimal place. That's a pip. One important exception to this is when the yen is the counter currency. Here, the 2nd decimal place is a one to watch. Except for when JPY is the quote currency, then the 2nd decimal place is the one to watch. Don't even know what 1.14. Cool. So second decimal place, 1, 2, 1, yep. Any extra decimal places shown in the price are known as fractional pips or pipettes. Any extra decimal places shown are known as fractional pips or pipettes. Question: if USD CAD price moves from 1.19527 to 1.19617, how many pips has it moved by? So a pip is the fourth, so 1, 1, 1, 2, 3, 4, 1952, 1, 2, 3, 4, 1961. So from 527 to 617, that is, let me just get a calculator. So 617 minus 527, 90. Oh, never mind. A pip is a move in the fourth decimal place. Oh, right, okay, so it's 4. So 61 minus 52. Oh, right, okay. 61 minus 52. Never mind. Okay, so it's 9. Okay, got it. What is a lot? Each 1 pip movement in the Forex price is only worth a tiny amount. So to take advantage of these small changes in values, Forex is traditionally traded in large batches called lots. The standard lot is 100,000 units of currency. Standard lot is 100,000 units of currency. You may also come across mini lots and micro lots, which represent 10,000 and 100,000 units respectively. A mini lot is 10,000 units of currency. A micro lot is 1,000 units of currency. Small investors generally don't have access to large amounts of money, so many Forex brokers allow clients to trade on leverage. Leverage essentially means you can open a large market position with a relatively small deposit called margin. Any profit or loss is based on the full position, however, so gains or losses could far exceed this amount. We'll look at leverage in more detail in the orders execution and leverage course. Leverage allows you to open large market positions using a small deposit called margin. Okay, video's not working. Major pairs. Theoretically, you can exchange any currency in the world for another currency, which means that the variety of Forex pairs you could potentially trade is vast. You could even speculate on the price of the Armenian dram versus the Zambian kwacha if you found a broker willing to trade that pair. In practice, however, the majority of Forex trades take place on a few selected currency pairs called the majors. What constitutes a major pair varies widely depending on who you speak to, but most include the following 6, which account for over 80% of the global Forex trade. So they all have USD in them, I'm assuming. Yep, they do. So Euro USD, USD JPY, GBP USD, USD CHF, USD CAD, and AUD USD. Notice that all these pairs include the US dollar, which is by far the single most traded currency in the world. So major currency pairs include the dollar. Minor and exotic pairs. Pairs which are traded less frequently are known as a minor currency pairs. You may also see them called cross-currency pairs or simply crosses, particularly if the US dollar isn't involved. The most popular minor pairs tend to contain the euro, sterling, GBP, or the Japanese yen, JPY. Minor currency pairs also known as cross-currency pairs or crosses tend to contain EUR, GBP and JPY. Some forex brokers may also refer to exotic or emerging pairs. These generally consist of one of the major currency against another from a small emerging economy. For example, GBP/MXN, sterling versus Mexican peso, or USD/PLN, US dollar versus Polish zloty. Exotic or emerging currency pairs include a major currency against another from a small or emerging economy. Finally, you may come across forex classes which are based on a region, such as Australasian pairs or Scandinavian pairs. These classes set currencies from their respective regions against one another, or pair them with others from around the world. For example, AUD/NZD, Australian dollar versus New Zealand dollar, could be categorized as an Australasian pair, while Euro/NOK, Euros versus Norwegian krona, could be a Scandinavian pair. Okay. Class the following pair, NOK/SEK. What's SEK? Scandinavian, maybe. Norwegian krona versus Swedish krona. Alright, okay. Class the following USD/JPY, that's a major. GBP/HUF, that's exotic, isn't it? Because HUF is like Hungarian, I think. Hungarian forint. AUD/NZD, that's Australasian. Euro/CAD, that is a minor, because it doesn't have the USD, but none of these two currencies are from emerging or small economies, so minor. What drives the forex markets? We've looked at what forex is and how to place a trade, but why do currency prices change? Well, currencies are effectively barometers for the health of the region they represent. So if you place a trade hoping a particular currency will rise, you are essentially betting on the economy of that country. In general terms, the stronger the economy of a country, the stronger its currency will be compared to other currencies. So the stronger the economy of a country, the stronger its currency will be compared to other currencies. Therefore, the factors that affect a country's economy tend to have the greatest influence on a currency's price. These include factors that affect the country's economy tend to have the greatest influence on a currency price. These include interest rates. These include interest rates, inflation rates, government policy, demand for imports and exports, economic statistics such as a county's growth figures, unemployment levels, and manufacturing data. Statistics such as a county's growth rate, unemployment levels, manufacturing data. Got a little video here.
Trading the news, an essential skill for all traders. Major news announcements can often cause large price movements, particularly in Forex markets. So here are 5 key pointers to help you try and make the most of those moves. Do your research. Know the times and dates of important events. Use an economic calendar, for example the one on IG.com. It's a vital tool to help you plan ahead. There are many announcements in any given day, so it's essential you know which will affect the assets you're trading. If a Forex trader, generally any event impacting the dollar is important. Non-farm payrolls, Federal Reserve minutes, GDP. If trading shares, look out for company earnings, dividend payments and stock splits. Then check what the market expectations are for the event. Look at a chart of what happened last time. How did the market react? Was the data better or worse than expected? Did earnings beat or miss estimates? Use what happened in the past to inform your future trades. Study related news and events. What else could impact the market in the wake of the announcement? Take crude oil. Inventories are due on Wednesday. If there's an oversupply, the price should drop. But say OPEC ministers are meeting Thursday. If they reduce output, the price could rise. So it's essential to look at the overall picture and not take each event in isolation. Put a strategy in place. Know what levels you want to buy or sell at and where to put your stop losses. This will help you to have the courage of your convictions and avoid knee-jerk reactions. And finally, learn when to fade the news. For example, the CEO of Company X announces he's leaving. The stock falls, but you believe the company's fundamentals are still sound and the market is overreacting, so you buy. If you're right and the price rises, you would have got in at the perfect time. Of course, if you're wrong and the price continues to drop, you'd make a loss. Remember, these are all just guidelines. While trading the news can be exciting, it is also risky. Unexpected results can lead to high volatility in the markets, so make sure you're well prepared and always have a solid trading plan.
Okay, so lesson summary. Forex movements are measured in pips. For most pairs, a pip is a 1-digit move in the 4th decimal place of the price, except for JPY, which is for the 2nd decimal place. Forex is traded in standard lots, which represent 100,000 units of currency. Currency pairs are usually classed as major, minor, or exotic. Generally, the stronger the economy of a country, the stronger its currency will be. What are commodities? Commodities are physical assets. Unlike shares, indices, or currencies, they are raw materials mined, farmed, or extracted from the earth. Some examples include. So commodities are physical assets. Gold, oil, wheat, and cattle. To be officially tradable, a commodity must be entirely interchangeable with another commodity of the same type, no matter where it was produced, mined, or farmed. A commodity must be entirely interchangeable with another commodity of the same type. So, for a commodity to be officially tradable, it must be entirely interchangeable with another commodity of the commodity of the same type, no matter where it was produced, mined, or farmed. For example, to a commodity trader, gold is gold. It doesn't matter where it was extracted. An ounce of gold mined in Australia is worth exactly the same amount as an ounce of gold mined in China, the USA, or Tanzania. The same can be said of other commodities such as natural gas, cotton, and copper, so long as they meet certain minimum quality or purity standards. Economists call this being fungible, and it means large quantities of commodities can be traded relatively quickly and easily on an exchange. This is because every trader can be confident they are buying/selling equivalent assets without needing to inspect them or find out where or how they were produced. Which of the following can be classed as commodities? Sugar, oats, was it? Yeah, that's it. Oh no, tin. Oh, tin is a metal as well. Yeah, I forgot. Oats, tin, and sugar are all fungible commodities, but plastic is not. There are hundreds of different types of plastic, all manufactured at different specifications. Types of commodity. Commodities are often placed in two groups. Two types of commodities. Soft commodities. These are agricultural commodities, farmed rather than mined or extracted. Soft tends to be very volatile in the short term as they're susceptible to seasonal growth cycles, weather and spoilage, which can suddenly and dramatically affect prices. Agricultural commodities. They tend to be very volatile in the short term as they're susceptible to seasonal growth cycles, weather and spoilage, which can suddenly and dramatically affect prices. Hard commodities. These are generally mined from the ground or taken from other natural resources. Hard commodities are typically easier to handle and transport than softs and are more easily integrated into the industrial process. So generally mined or taken from other natural sources. Generally mined from the ground, farmed rather than mined or extracted. Farmed rather than mined or extracted. Taken from other natural sources. Typically easier to handle and transport than soft commodities. More easily integrated into the industrial process. You may also see commodities classified according to their ecological sector. Energy, metal, agricultural, so energy includes oil and gas, metal, gold, silver, copper, lead, etc., agricultural, wheat, coffee, livestock, etc. Also, Commodities can also be classified according to their ecological sector, energy, metal, and agriculture. Oil and gas, gold, silver, etc. Agriculture, wheat, coffee, livestock. Wheat, coffee, etc. Is the following a hard or soft commodity? Orange juice. Soft. Brent crude oil, that's hard. Palladium, that's hard. Soybean, soft. How are they traded? There are two main ways to trade commodities, the spot market and the futures market. Two main ways to trade commodities. The spot market. So, the spot market is where financial assets are sold for cash and exchanged right there and then. Where financial assets are sold for cash right there and then. And exchanged. Right there and then. So if you need immediate delivery of a commodity, you head to the spot market. Head to the spot market if you need immediate delivery. For example, say you ran a business that built industrial pipes. You recently got an order for a large amount of copper piping, but there's none left in the warehouse. You need the copper immediately, so your best bet is go to the spot market and buy some. Similarly, if you own a mining company that has some copper you want to get off your hands straight away, you try and sell it on the spot market. Due to the large quantities of commodities traded, and global nature of these trades, set standards are used by the spot market so traders can buy and sell commodities quickly without the need for a visual inspection. The futures market. The futures market is a place where buyers and sellers agree to exchange a specific quantity of an asset at a fixed date in the future at a price agreed today. Where buyers and sellers agree to exchange a specific quantity of an asset at a fixed date in the future at a price agreed today. The assets in question are not physically traded on an exchange, so the participants buy and sell futures contracts instead. This enables traders to speculate on the price of commodities without having to own them at any point, because the contracts can be sold or closed before the actual delivery dates. So the assets are not physically traded. Participants buy and sell futures contract instead. This enables traders to speculate on the price of commodities without having to own them at any point, because the contracts can be sold or closed before the actual delivery date, which is particularly useful if, for example, you want to trade on the prices of cattle but don't want several herds of live cows delivered to your door in a few months' time. While futures contracts are often used by individuals and companies looking to exchange physical commodities at a later date, they are predominantly used for speculation and hedging. It's also worth noting that the price of futures contracts tends to be different from buying or selling an identical amount of the same commodity on the spot market. That's because the seller needs to take into account future risks and charges, such as the cost to hold a commodity and then transport it to the buyer. Hence, futures contracts are valued using forward prices rather than spot prices. So, futures contracts are valued using forward prices rather than spot prices. Okay, who trades commodity futures? There are four main types of commodities futures trader. Four main types of futures commodities trader. Producers. These are the companies / individuals that produce or extract commodities that enter into a futures contract to offset the risk of future price movements. If, for example, you are a coffee farmer and agree to sell your yield for a specific price on a specific date, you will have a guaranteed income on that date even if coffee prices plummet in the meantime. Producers. So the companies / individuals that produce or extract commodities and enter into a futures contract to offset the risk of future price movements. Speculators. These are traders looking to solely profit on commodities price movements. They generally have no interest in owning the physical commodity itself. Traders who solely look to profit from the commodity price movements. Hedgers. These are mid or long-term investors who hold on commodities in their portfolio to provide protection against downward movements in other securities. Commodities tend to move in an opposite direction, or at least an unconnected direction, to certain stocks and bonds. In the event of a stock market crash, for example, investors holding commodities may not suffer as badly as those with exclusive share-based portfolios. Gold in particular is seen as a safe haven and receives significant investment when equities are unstable. Mid or long-term investors who hold commodities in their portfolio to provide protection against downward movements in other securities. Commodities tend to move in opposite direction, or at least unconnected to certain stocks and bonds. tend to move in an opposite direction in an, let's go on in an unconnected direction to certain stocks and bonds. In the event of a stock market crash, for example, investors holding commodities may not suffer as badly as those with exclusively share-based portfolios. Gold in particular is seen as a safe haven and receives significant investment when equities are unstable. Gold is seen as a safe haven and receives significant investment when equities are unstable. Brokers. These are firms or individuals who buy and sell commodity contracts on behalf of their clients. Firms or individuals who buy/sell commodities contracts on behalf of their clients. Cool. So, lesson summary. Commodities are physical assets that are mined, farmed, or extracted from the earth. There can be soft commodities, agricultural, or hard commodities, energies, and metals. They're traded on either the spot or futures markets, and the spot markets generally for buyers and sellers of the physical commodity, while the futures markets tends to be dominated by speculators and hedgers. Cool. Trading commodities. Commodities are bought and sold on a number of exchanges specializing in a particular type of commodity. LIFFE, the London International Financial Futures and Options Exchange, is the largest trading floor for commodities in Europe. Specialty, soft commodities, cocoa, wheat, coffee, sugar, corn. New York Mercantile Exchange, the world's largest physical commodities futures exchange. Specialty, energy and metals, crude oil, natural gas, heating oil, RBOB unleaded gas, gold, silver, copper, platinum, palladium. London Metal Exchange, the world's leading non-ferrous metals market. Specialty, metals that do not contain iron, aluminium, copper, tin, nickel, zinc, lead, aluminium, alloy, cobalt. ICE Futures US, a leading global soft commodities futures and options exchange. Specialty, soft commodities, sugar, cotton, cocoa, coffee, orange juice. Chicago Board of Trade, the world's oldest futures and options exchange. Specialty, grains, corn, soybeans, soybean oil, soybean meal, wheat, oats, rough rice. Contract size, commodities futures are traded in contracts. Each commodity market has a standard size set by the futures exchange where it trades. Each commodity has a standard size set by the futures exchange where it trades. As commodities are often bought and sold in large amounts, the contract size also tends to be large. Let's take gold as an example. The contract size for gold futures is 100 troy ounces. So if gold is trading at 1,100 per troy ounce and you buy just one contract for it, your contract will be worth £110,000 or $1,000 because it's 1,100 times 100 ounces. Small investors generally don't have access to such large amounts of money, so just like when trading Forex, you can trade commodities futures on leverage. Many exchanges and brokers also offer mini contracts, which tend to be between 10% and 50% of the size of a standard contract. It's very important to note that both standard and mini contract sizes are very wait. It's very important to note that both standard and mini contract sizes vary widely depending on the type of commodity, so it's vital to check the contract sizes carefully before placing a trade. Check contract sizes carefully before placing a trade. Question: the contract size for silver is 5,000 troy ounces. If you bought 10 silver contracts at 17.05 per troy ounce, and the silver price then rose to 17.15, how much profit would you have made in dollars? So, 17.15 minus 17.05, so everything increased by 0.1, times by 5,000, times by 10, 5,000. Boom. Very good. What drives commodity prices? As with all trading, the most important factor that affects commodity prices is a balance between supply and demand. Supply and demand affects commodity prices. If, for example, there's a good cotton crop which boosts the amount in circulation, the price of cotton will decrease, assuming the demand remains the same. On the other hand, if clothes manufacturers and other companies using cotton needs more of the commodity, but producers don't have the capacity to match this demand, the price will increase. Other factors that drive commodity prices include the weather. Factors which affects commodity prices. Supply and demand. Weather. Agricultural commodities are particularly dependent on the weather as it influences the harvest. A poor harvest will result in low supply, causing prices to rise. Cultural commodities particularly dependent on the weather. As it influences the harvest. Poor harvests will result in low supply, which increases its prices, which increases the price. Economic and political factors. Events such as war or political unrest can have big effect on prices. For example, turbulence in the Middle East often causes the price of oil to fluctuate due to uncertainties on the supply side. So war and political unrest can cause uncertainties on the supply side, which causes price to fluctuate. The US dollar. Commodities are normally priced in US dollars, so their price generally moves inversely to it. If the price of the US dollar falls, it takes more dollars to buy the same amount of commodities, so the price of commodity rises. Conversely, if the US dollar goes up, then it's cheaper to buy commodities, all things being equal. Commodities are normally priced in USD, so their prices are inversely inversely correlated. If the price of USD falls, it takes more USD to buy the same amount of commodities. So the price of commodities rises if the price of USD rises. It takes less USD to buy the same amount of commodities, so the price of commodities falls. Okay, lesson summary. Commodities are bought and sold on special exchanges in contracts. Contract sizes vary depending on the type of commodity traded, but tend to be very large. However, small investors can usually buy and sell commodity futures using leverage. Commodity prices are often very volatile and are affected by supply and demand, the weather, geopolitical factors, and the value of the US dollar. Cool. I'm going to leave this episode here then. So in the next video we're gonna do the quiz of this lesson. So I think, what is this called? What is financial trading, right? So introducing the financial markets. Okay, that. So we're going to do the quiz for introducing the financial markets in the next video. I will see you guys then. Peace.